Thank you everyone for joining. Oh, thank you, Charlie. And thank you everyone for joining this webinar. It's a sunny afternoon, certainly in Derby, it's very sunny. So as Talia said, I'm a partner at Claritas Tax. I'm head of M&A tax in the team. My brief, just a bit of brief background about me. I trained to be a barrister, but I'm also a chartered tax advisor. So my role predominantly at Claritas is to advise owner managed businesses, as well as private equity, both buy side and sell side of businesses. My objective today is not to make you M&A tax experts in 1 hour. I wish I could, but unfortunately that's not the case. But I will give you a general awareness of what we commonly see on transactions, certainly in the M&A space. There will be matters which I'll skim over quite quickly, but if you are looking to do M&A, any type of transactions, please do take advice, because there'll be things in here which I'll talk over, glean over very quickly. There will also be items which I don't mention because due to time constraints. So yeah, do get in touch. So let me still get the first slides up. So my first slides is all about preparation. I'll talk about some of these concepts, some of these points in more detail in a second. My first slide is all about, is your house in order? Are you basically prepared for the storm? Because there are a number of things that you need to get ready, be prepared for when you enter a transaction process. For example, are all your tax affairs in order and well organized? Do you have the correct corporate structure in place? For example, have you got a group where one of the businesses is key for the transaction, actually the other business is not? So do we need to do some kind of demerger of that business to get one of the companies out tax efficiently? And you need time to do that. And certainly you need at least 3-4 months to do that before you enter a transaction process. The other one we see a lot is, are there any non-core assets in the business? The ones we commonly see are commercial property, where buyers doesn't want to keep the commercial property. We've also seen residential properties. I've also seen vintage cars, bizarrely. But so those are usually non-core assets the buyer doesn't want. So we then need to plan around how can we get these assets out tax efficiently as possible, and have enough time to write to HMRC if we are doing some kind of formal demerger. The key takeaway from this slide, which I'll talk about again next couple of slides, is about management. We always see that, certainly for private equity type transactions, and certainly for management buyouts, with the two common ones I'll talk about shortly in terms of structures, the management team are key. Any potential buyer will want to see that you have the right management team in place. They want to back the good management team. So you want to ensure, certainly as a seller, you want to ensure that you have identified the right team, that those are the ones you want to back the business, or will stay with the business throughout the exit, and also stay with the business post-exit as well. So you want to ensure there's a number of things you can do to incentivize and motivate those individuals. For example, I was at a meeting on Friday where it's a 2-year plan before a sale. They had identified 3 individuals that they'd want to back for a sale to PE, I think it is, from memory. But 2 have left already. So now they've got to go into another process where they need to identify 2-3 more people to basically back the next management team, because they want to fully exit. So it is a very important process and that's a key takeaway from this slide. And I can talk about what kind of things you can use to incentivize a management team. The next point to consider is longer term plans. So essentially, when you sell a business, shares in a business, so shares in a trading business are exempt from inheritance tax purposes. So it's outside of your state for IHT purposes. So you can avoid that 40% tax problem on death. However, as soon as you convert those shares into cash, you create a 40% tax issue. I.e., if that cash is still in your estate on death, then there's a potential for IHT on that at 40%. So there are a number of things you can do pre and post transaction about how you manage your IHT exposure. You might have heard of things like family investment companies and using trusts pre-sale to transfer value to trust pre-sale. So these are things to think about, a few of the things to think about. There are a few slides at the end of this session which talk about some planning opportunities. If I get time, I will go through them. But if not, they're there for food for thought. And if you've got any questions, then do let me know after the webinar. So next slide. So the next slide is all about management incentivization. I said this is very important. So a couple of things of ways to, key things, ways to incentivize and motivate valuation are, one might be an exit-based bonus, i.e., if they stay with the business, and they're contingent on an exit, you can give them a bonus which is contingent on an exit. So if they don't stay at the business, they don't get the bonus. But if they do stay with the business, they get a nice sum of money on exit. The problem with the bonus, exit bonuses, is subject to PAYE, so it could be up to 61% in tax. It's very tax inefficient. And also for corporation tax purposes, because the bonus is related to a capital event, it's not deductible for corporation tax purposes. So it's a very expensive way to incentivize and motivate an individual. But what we tend to see in a better way to incentivize an individual is, and what we've probably heard quite a lot of, is something called enterprise management incentives. It's basically a share scheme. And so you can HMRC approved share scheme. And the beauty of this share scheme is that you can agree a valuation in advance of putting this share scheme in place. And if you issue options to the relevant individuals well before a transaction, you can get a huge amount of discount on the valuation. Say, for example, there's no market for the shares. You're 2-3 years away from a sale. The market value shares, say, at that point is £100 in total, just for argument's sake. Because this person will have a minority interest, or potentially to have a minority interest, say up to 10%, then you can apply substantial discounts to that valuation, up to 80%. So whilst the shares might be worth £100 today, 2-3 years before a transaction, you can get those shares at a price of around £20 per share. So it's a huge discount, very affordable way to get shares in a business, or certainly options in a business. And then you can link that to an exit. So all they get is an option to acquire shares immediately before an exit. You might have heard them called exit-based options. So they already get those shares right before an exit, and then they pay their £20 a share at the time, and then they get shares and roll over into the acquiring vehicle. There's a lot of conditions to be met, both individual as well as company conditions. And what we see a lot on due diligence exercises is certainly around share schemes generally, and share schemes and shares transfer between individual shareholders. It's probably one of the most common things that people get wrong. So make sure you have plenty of time to go through all the conditions and make sure it's done properly by good advisors, essentially, that know about EMI share options. The key thing about EMI options is that as long as the individual holds the options for 2 years before an exit, or 2 years before the exercise, and they're still an employee at the time, then the first £1 million of capital gain is subject to, both qualifies for business asset disposal relief, i.e. entrepreneurs relief. So it's a massive incentive. You can compare that to the bonus exit type bonus arrangement. It's a lot cheaper, and actually the tax benefits a lot more efficient as well.
Sorry, can I just trouble you to change the settings on your presenting? So if you go on to that display settings and just do current slide. I think a couple of people can see your screen, but it's a bit small.
Current slide on display settings. So I'm here now, sorry. On here, you mean?
On here, on the webinar, can you see at the top? It might say show taskbar, display settings, and end slideshow. And on that display settings in the top.
I can't see it. So, yeah. Sorry, everybody. Display, so I can't actually see it on my screen. Shall I? Is it actually on the slide deck itself?
It's not the slide deck. It should be on the actual Zoom.
The Zoom thing.
Yeah.
So we've got audio, video, participants, chat, raise hands, share, Q&A.
So if you come up, so that's the bottom toolbar on the above where you're displaying, where it shows your presentation.
Oh yeah, I've got it's not showing, it's not coming up entirely. Let me see if we get this one up here.
Apologies, everyone.
I can't see it on here, Tony. Display settings. It's annoying, frustrating. Hold on. Is it just too hazy or something, or?
I think it's smaller for some people. It's showing a full screen for me, but I think some people can only see a smaller version, a condensed version.
Should I stop sharing and try again? Should I do
Yeah.
that? Yeah, so apologies, everybody.
If you try doing share screen, but do your screen instead,
Yeah,
and
okay.
it will open it up into PowerPoint.
Right, let me just let's just do that. Share screen. Lost it now.
Go into your PowerPoint.
Is that better?
Lovely.
Is that better?
Yeah, I think
It's better. Yeah. Sorry, everybody.
Ess.
Cool. Okay. I'm tax expert. We're not a tech expert, so there you go. So apologies, everybody. So yeah, so that was the EMI, sorry, incentivization of management side of things. So the next thing I want to talk about is all about getting your ducks in a row, i.e., again, the point of brand preparation. So one of the things we always say to a potential selling team is, have you considered a vendor due diligence? That is where a seller gets a team like us to come in to do basically vet the business, do a health check on the business to make sure that all the tax affairs are in order. If they're not in order, when we identify anything that that needs rectifying, then at the end of the day, we would go in, we would do a report, we identify any issues that have come up, and then we would try to, with the sales side team, we would try to resolve those issues in advance of going into a process. And that is quite a key thing, certainly in the current market, given the economic market, the economic and deals are falling over all over the place. So to have a health check on the business before you enter a process is quite a powerful tool. And also from a buy side point of view, certainly buy side perception, when I'm working on behalf of a buy side team and I go and do a due diligence, if I can see that the affairs of the target are well managed, you know, that there's a VDD has been undertaken, they've identified the issues, they're on top of the issues, naturally it gives the buy side team, certainly me, a lot of comfort. So I don't tend to dive in as much and you know, don't want to scratch beneath the surface too much because I know they're well managed. However, on the other side, if I think there's issues arising all over the place and it makes me really nervous, so I want to dig more and more and more. So it's certainly worth thinking about a vendor due diligence and health check of the business before we enter a process. At the end of the day, this is what I call, you know, you rehearsal for the main event, because you'll have all sorts of questions when you enter the deal process. So if you're well versed in all the issues already, you've kind of rehearsed the questions through this process, then when you go into the process itself, you'll be a lot more well versed in all the matters. The only thing to check is to ensure that you are still qualifying for business asset disposal relief, what used to be called entrepreneurs relief. Things happen throughout the time life of a business around the share, so you just want to make sure that you're still qualifying, you've not actually scuppered your entitlement to business asset disposal relief. And the last point again is about planning, which I talked about at the very start, about estate planning, making sure that you're managing your IHT exposure, you know, using pre-sale or post-sale family investment companies or trust planning or something else that, you know, you might want to consider. So just before I go to the next slide, Talia, are there any questions from those couple of slides I've been through there?
Yes, I did have one come through which noted, it says, what happens where you've paid tax up front, but the ascertainable considerations isn't actually paid out?
So for that one, that's a question for a bit later on. So I will address that. That's about earnouts and deferred consideration. So I will address that question slightly later on because it makes sense in that context. So I'll pick that up at that point. So next thing I want to go to, sorry, is I'll talk about a couple of common structures that we see most of the time. The first one is private equity, and the second one is management buyouts. So these are common structures we see. There's all types of different structures, as you can imagine, but the aim of this webinar is to talk about what we commonly see. So this is your typical private equity structure. It looks a bit complicated, but it's very typical, and they don't really differ too much from this. The reason why you might have 2 or 3 acquisition vehicles, a topco, bidco, and midco. And the reason why you have that is all about debt subordination. So, you know, the third-party debt, maybe HSBCs, always wants to be closer to the assets, so they'll go into bidco. Midco will be your mezzanine debt, so it's not quite as important, so to speak, as the third-party debt, but it's more important than management debts and investor debt. So that goes into midco. And topco, you have your usual management investors, your loan notes from them, your ordinary shares or preference shares, etc. And you might actually always have, you might also have two vehicles where, because you might not have mezzanine debts, you might have a topco and a bidco, for example. But this is very typical of a private equity structure anyway. But on a sale to bidco, Target would initially pay cash and possibly an earn-out to the shareholders. And then what would happen is, if they want the management team to stay around, or certainly the shareholders teams to stay around, then what we would also get is loan notes and possibly preference shares or ordinary shares into Topco. And there's a way to do that. You roll up through the structure to get the shares and loan notes in Topco. So there's a way to do that. But typically, this is how you see a private equity structure. And I'll talk about the constituent parts consideration shortly. MBO. Oh, the one thing, sorry, before going ahead, the one thing that's something worthwhile noting about private equity is, because it's a competitive process. You enter, for example, I'm working on a deal where private equity is coming to acquire a stake in the business. They had 8 bidders, so it's a very competitive process. So naturally, I think the view is you get higher price, and certainly you get a day one cash is always a bit higher. I always tend to see, because you want to look after the management team, certainly PE do. So that is the kind of the upside of having entering into a private equity structure. There are things like reporting obligations, and you have the private equity parties, investors have a lot of step-in rights, etc. So there are pros and cons for doing a private equity structure, which I'll compare to an MBO. So an MBO simply is, again, we talk about the management team. We talk about management team previously in a PE structure, which is why I've talked about it at the very start. It's very important to have you've identified a strong management team that will take the business forward. Again, both private equity and certainly in this structure, you have a management team that you rely on to take the business forward. Typically in an MBO structure, you'll have cash, day one cash, you'll have deferred consideration, and a bit like private equity, but you'd also have shares in Newco as well, just like private equity. Usually, because you're kind of doing like an internal type of transaction with the management team who you trust. The cash in day one is not as high. You might have third-party debt in there to increase the cash, but compared to PE, the cash is generally slightly lower to deferred consideration, where the shareholders, the former shareholders, cash consideration is paid out over a number of years, as well as shares in Newco. The pros of doing this is it's probably an easy process to manage, because the management team, you've backed them for years. Now they're backing you as well, because they're taking the business forward. Generally, probably the price is slightly lower than what you get in a private equity transaction, but here the people, and you trust the team, so they're good for what they're doing. So there is pros and cons for doing an MBO structure or PE structure. But again, the key takeaway is the strong management teams in both. So just going to talk about the constituent consideration parts of what we just talked about in terms of private equity and MBOs. So just going to talk about the tax impacts of these parts. So cash, deferred cash, that's a simple one. It's tax on completion, so that's a tax year of disposal. You pay tax on that, capped against tax, hopefully, at that point. An earnout, well, an earnout, that's dependent. That's usually an earnout is basically an element of price contingent on the performance of the business post sale. So an earnout is a good tool, certainly in the current market, where buyer and seller expectations can be different. The buyer always wants to pay less. The seller always wants more than they think they should get. So the way to fill the gap is by using the earnout. And essentially, it's a buyer's way to say, well, put your money where your cash is, or your mouth is, sorry. So that, if you think it's worth this, then you can get it, but you have to wait a few more years. But it's based on certain EBITDA results, for example, in the future, year 1, year 2, year 3. If you meet those targets, then you'll get the price difference. So it's a good tool to use, and certainly we see it a lot in the current market. The rollover consideration, that's shares or loan notes. We'll talk about that again in more details. We'll talk about earnout and rollover in more detail in terms of rules. That's essentially, if you fall in the share for share or share for securities rules, the rollover provisions, then the default position is not taxable in the year of disposal. what happens is that those items, like for shares, for example, the tax comes back into charge when the shares are sold in the future. The loan notes are taxed in a year when each year the loan notes are redeemed. So that's a default position. And we'll talk about, CGT. These are all those three: cash, earn out, and rollover. You'd expect to get capital gains tax on all of those, but it's not a guarantee because there's a number of anti-avoidance provisions you have to consider. And I'll talk about that in a second as well. Just a caution, I'm not going to labour this point because it is an issue, it's a whole topic in itself, employment-related securities. And that is where basically it basically means that someone has received, an employee has received shares or securities, i.e. loans, by virtue of their employment. And in the context of a transaction, that can happen where historically you've paid less than market value for your shares, and there's a potential income tax charge there, and also a potential income tax charge on a transaction if you've not made a relevant election at that time. It's what they call a 431 election. And also, if you're on a sale, you get more than the market value of your shares, i.e. your capital right. Say, for example, you're already entitled to £1 million of value in the articles, but you get £2 million of value, then you've obviously got more than market value than you're entitled to. So that extra £1 million will be subject to PAYE. So something just to think about. And again, if you go into this process, it's very important that you consider employment-related securities. I've recently done a PE transaction with a big PE house, actually, and this caused a massive issue, and a massive commercial issue, not just a tax one, to the point where it could have affected the deal. So it's something just to think about. And again, any questions, please do ask. So the first one I wanted to talk about was earnouts, because we see a lot of these and they're quite complex. The next slide, there is an example just to put a bit of context around this. So basically an earnout, it depends on whether it is ascertainable or unascertainable. And ascertainable, basically, that essentially is where all the events that determine the amount are known at the time of completion. Then the whole amount would be brought into tax on completion. So it's a bit like, basically treated like cash. And so it's taxed in the year of disposal. And there's as I say, there's an example in the following page, which I'll go through again. Unascertainable, that's a bit more complex, because the thing with unascertainable consideration, unlike ascertainable, is that the events or the amount is not quantifiable at the date of disposal, because it's dependent on future events. So the events have not happened at the time of disposal. So things like, EBITDA targets, and if you meet EBITDA targets in 25, 26, 27, for example, you'll get a percentage of profits in that year, but we don't know what those are. So there's two. So for unascertainable consideration, it's a bit of a complex one. It's a bit tricky. There's two tax points. The first tax point is that you have a right to receive income in the future, or consideration in the future. So that right itself that you have on day one to receive further consideration in the future, that's also an asset. So HMRC, and this was considered in the House of Lords in the case law, that right itself is an asset. So what you have to do, the right to receive something in the future, that's an asset that's worth something. So you have to get someone like us, do a tax evaluation of that, what that asset is worth. Whatever valuation you get on that asset, the right to receive something in the future, is then put on your tax return, and that's taxable in the year of disposal. Then obviously you've got an entitlement to for future consideration, further consideration. So in that case, what happens is, if you meet your targets in year 1, year 2, year 3, post-transaction, then you'd be taxed on those as well, subject to capital gains tax in the future at the prevailing rates. So, obviously the downside of that is you don't know if the rates are going to change. So in year 1, year 2, year 3, so you have to be mindful of that. And also, there's an impact on business asset disposal relief, i.e. entrepreneurs relief, or used to be called entrepreneurs relief. That on day one, because you qualify for entrepreneurs relief, well, you did, or the first £1 million of consideration is subject to CGT. But if you haven't used all your lifetime allowance, which is £1 million, but you've sold all your shares, or you've no longer qualified for business asset disposal relief because you've fallen below the threshold post deal, then it means that your consideration, or your unascertainable consideration that's received in the future, would be taxed at the higher CGT rates, and currently 20%, because you no longer qualify for business asset disposal relief. So that's something to think about, because there are things we can do to basically bring forward a tax charge on unascertainable consideration, so that it's all taxed on day one. But obviously you've got to fund the tax. But there are things, as I say, we can do to to manage the timing of tax. And certainly with political unrest and election coming up, some people take the view I'd rather pay the tax up front, lock in my tax at 10 and 20% and take the hit, and I'll use the cash from the sale to pay the tax up front. Some people take the opposite view. So it depends on your view on these matters. The other thing to think about is just a few points on earnouts. HMRC do look at these earnouts and consider whether actually what you've given is more akin to income, employment income, not a capital transaction. So what the things to think about are that HMRC look for is that all parties have agreed an arm's length price for the sale of their shares, so they all receive equal consideration, equal to their capital rights in the articles. The parties are paid market rate salaries, so you've not reduced your salary going forward to get more capital proceeds now. That's something to keep an eye on. And also one of the key ones is if there's any performance targets, i.e. EBITDA type of targets, it's not based on personal performance, it's based on business performance. And that's quite key, because if it's personal performance, that's a strong indicator that it's more like an income type consideration, not a capital consideration. So things to think about when you look coming into these in earnout consideration. And they usually are set out in the sale and purchase agreement. There's usually a tax deed at the end, an appendix to the tax deed. So it's certainly worthwhile looking at that when you're going into reviewing the SBA. We do it all the time. So if you need any help with that, please do say. So just an example, just to put this into context. I know there's a lot of technical stuff here. So just a very simple high-level example of what an ascertainable consideration would look like. Here, for example, just reading off the screen, the agreement for disposal of an asset that provides for consideration of 300 grand, of which 100,000 was payable on completion and 200 pounds is payable I think it's 4 installments after completion. Here we know all the events that define the amount are already known at time of completion. There's a set amount that's not going to change. So this is clearly ascertainable. So all of that would be taxable in the year of disposal. And there's a bit of blurb there about what the defining features are about deferred consideration. So that makes it easier to identify. Examples of unascertainable payments are, for example, here, there's a right to 3 payments of deferred consideration in cash, the amount calculated by reference to profits of the business in the next 3 years. And then you've got the second one, which is based on percentage of future EBITDA numbers in 25 and 26, with a maximum of £1 million for each payment. So in both cases, the events that determine the amount are not known yet because it's dependent on future results. So it's clearly unascertainable in both situations. So again, you come into that funny 2-tier approach where the right to receive future consideration is taxable in the year of disposal, and then any subsequent payments, if you meet the targets, are taxable in the future years. And I think, Talia, your question again, Talia, about is there a way to get the tax back or make a claim for tax back you've already paid on these
Do you want
items?
me to read it out again?
Yes, please. Yes, please.
Yeah.
Yeah.
So what happens where you've paid tax up front, but the ascertainable considerations isn't actually paid out?
Yeah. So yes, that's always a risk, isn't it? Because what the situation there is, what Talia's referring to, the question there is where you've got a situation where you put the amount on your tax return, and actually what happens is in the future, so you put the full amount, so you're ascertainable, and even in unascertainable, you get the right to get future consideration. That's also put on your tax return and the year of disposal. What happens if it doesn't pay out? Well, in both cases, an ascertainable and unascertainable, they're different parts of legislation, but you can make a claim to HMRC. I think if you make it within 4 years of knowing that these gone bad, you make a claim to HMRC to get a refund or an offset of the capital gains tax paid at the time. So there are forms and there are mechanisms you can use to get the tax back. Otherwise, it'd be materially unfair, as you can imagine, which, it's a good question because you don't know with HMRC. Right, I'll move on to the next one.
2 more questions, Seth.
Okay, yeah.
So one person says, could you run through the different treatment of QCB and non-QCB loan notes?
Yes, I shall. That's literally on my next slide, so I'll do that in a second.
Okay. And then another one has said, if a seller provides a free handover for a period of time post-completion, might HMRC look at that more like income?
A free What do you mean there's no
So
payment for the
free
services?
inverted commas, like handover for a period of time post completion. Might HMRC look at that more like income?
So I think I think I need a bit more context of the question, but we're just going back to what HMRC would expect. They would expect to see a market rate salary for the person who stays on. So, but equally, if and there's a number of points you have to consider. But if the other parts, like negotiated the deal on arm's length terms, everyone's got the same deal. There's no individual performance targets, and everyone's paid equally. And then, so as long as the other factors pointed in the right way, then you would say it's probably wouldn't be at risk. But equally, that being paid, you want to make sure that the individual in question hasn't received extra, consideration at the cost of not getting any salary or working for free. That's something that you have to be mindful of. But I think there is an element of risk there, definitely. But it's all in the grand scheme of the things that HMRC look at. Okay. Any more questions, Sally? Shall I move on?
That's it for now. Thanks,
Okay.
Ed.
So yes, so Rolo, so this is so I'll pick up QCBs here because it's the last point I mentioned. So we talked about one of the other parts of consideration was shares or low notes. So there's a part of the legislation in the capital gains tax rules. It's under section 135 for those who want to know what it is. Basically, that says that as long as more than 25% of the target has been acquired, then any shares or securities, or in this case, low notes, are given as consideration, issued as consideration, then the shares of loan notes are not subject to tax. They basically what happens for those is they stand in the shoes of the original shares, and they take on the original base cost as well and the original time of when they acquired those original shares. The base cost is divided between the shares and the loan notes or other securities acquired on an apportionment basis. The key thing here, so and then the other part, and I'll talk about the clearance process in a second, but the key thing here, when we talk about more than 25% of target, that's easy when you've got, when you've got 100% acquisition, it's fairly easy because that's you're naturally going to fall within those rules. But 25% isn't 25% of the number of shares in issue. It's 25% of the nominal value of the shares. So that's key, and that's key for all tax purposes, tax rules as well. So when tax looks at ordinary shares, we look at the nominal value of ordinary shares, not the number of shares. That's something to be very much aware of. That's also relevant for things like a business asset disposal relief as well, and for corporation tax purposes like substantial shareholders relief. So there's a number of taxes across the UK tax legislation look at the shares by nominal value, not by number of shares held. So that's something, I'm labouring the point there, but it's something that's missed quite often. The other part of the kind of rules and reorganisation rules is that you have to satisfy HMRC and certainly rules that the transaction has been done for bona fide, i.e. genuine commercial purposes. So we tend to go to HMRC, write to them because it's a clearance process. You can write to HMRC, and we probably have all heard, whereby you can ask them, look, this is a transaction, set out the transaction, set out the commercial rationale, hence the genuine commercial purposes test of why the transaction has been undertaken. And what we're looking to do there is get HMRC to agree that we fall in with these reorganisation provisions. They're happy it's done for genuine commercial purposes, and i.e. we fall within the CGT rollover provisions, and they're not going to subject any consideration to dividend rates tax or anything else. So we fall in these reorganisation provisions. Shares and ordinary preference shares. We talk about ordinary shares or preference shares, so that sometimes you see in a transaction. I'm not going to labour that point too much. HMRC don't generally like redeemable preference shares, and that is basically like where you have it's basically loans in a tantamount to loans in another form. It's equity, I suppose. So what happens is there'll be an agreement to buy back the shares over a number of years, and it looks more like a loan as opposed to genuine equity that is only bought back on an next sale, and there's no buy, there's no regime to buy those shares back over a number of years. HMRC don't generally like those because I see it's tantamount to cash. So these questions, I want to get into this quickly, the low notes point. So yeah, low notes, generally you might see, in someone's obviously mentioned it, they're generally seen as or termed as qualifying corporate bonds or non-qualifying corporate bonds. Basically, in simple terms, once it sounds complicated, it's just debt, low notes debt. There's no definition for tax for what qualifying corporate bond is or what a non-QCB is. It's a legal definition. The key thing I would take away is don't dwell on the QCB and non-QCB in terms of what it is and is it overcomplicated. Just I would say dwell on the tax treatment because there is a difference on the tax treatment. So when you have a qualifying corporate bond, what happens if you sell a business and you have a share for securities exchange, so you might have some shares in the acquirer and you might also get some loan notes. If you get loan notes, what happens there is the tax at the time is calculated on that loan note at the time of disposal, but it's frozen. So tax is frozen, calculated at year disposal, time of disposal is frozen. So every time the loan note is redeemed in the future, the tax is paid triggered at that point, which is all fine. It's all fine if the business is doing well and the taxes and you repaid your loan note so you can pay your tax. But the downside is if, however, the business gets itself into financial difficulty and the loans go bad and you can't pay the loan notes, what happens in the QCB situation, because you've calculated and frozen the gain, what happens is that gain comes back into charge, notwithstanding that the business can't pay the cash on the loan notes. So you have to stump up for the tax, and notwithstanding that you haven't got the cash to pay the tax, or you have certainly had the money from the loan notes. So it's all about managing bad debt. So this is the reason why we always use non-QCBs, because the trick with non-QCBs is that at the time, in contrast to QCBs, at the time of disposal, you don't calculate the gain. It's not frozen or calculated at the time. The gain is only calculated every time you redeem the loan note. So in year one, the loan notes are paid, you calculate a small amount of gain, what the tax is, and that paid in year one, year two, year three, etc. But if year two and year three it's gone bad and you haven't got the money for the loan note, there's no tax to pay. So yeah, in fact, it probably ends up with a loss. So that's the beauty of having loan note, non-QCBs, a loan note has non-QCBs because you can manage the bad debt side of things. So the key thing to look out for when you're looking at the legal drafting is QCBs tend to always say that you can only redeem the loan notes in sterling. So in order to make it a non-QCB, when we review the loan note documents are very standard, legal documents are very standard. So what we tend to say, because we want a non-QCB, is we insert a currency conversion clause, i.e. the loan notes can be redeemed in a different currency other than sterling. And there's no other, technicalities there, but that's the main one. And that then suddenly converts what would naturally be a QCB into a non-QCB. And that's the key takeaway from the QCBs, non-QCBs. And I hope that makes sense for the person who asked that question. The last point here, section 431 elections, we've probably all heard of them. It's an employment-related security matter. It's important that when you acquire shares or loan notes in the inquiry business that you sign a section 431 election. It's all about valuation here, that if for some reason you've acquired securities, that's been shares or loan notes for above market value, then what happens? But at the time you didn't know, or there wasn't the right, you didn't have the right tools to calculate the valuation. It's very rare it happens, but it can happen. And actually it's usually a request from the purchaser anyway to make sure you sign a 431 election. So what happens is at the time of acquiring those shares and loan notes, if there's any difference between the market value, the items you receive, the consideration received, and any excess above that, then any income tax exposure is limited to that day one consideration. So then any growth in value after that day one, because you paid your tax and then you paid your income tax at that point. So any growth in value from after the post deal is all subject to capital gains tax only. If, however, you don't sign a section 431 election and there is an exposure to ERS, employment-related securities, what happens, a proportion that is subject to income tax at the time, that growth of proportion is subject to income tax also the next disposal, and obviously a proportion is subject to capital gains tax. So it can become very expensive on the next disposal. So we'd always say sign a section 431 election. You have to do it within 14 days of acquiring those securities, the shares and loan notes, and you should do it anyway as a default because it just protects everybody and keeps everyone in a comfortable place. Just a quick on the next one. I'm not sure what the time is. I'm conscious of time here, so I'll try to get through this as quick as possible. So this is just a simple an example of a rollover. So just to put it in context. So Joe acquires his 1,000 shares in Claritas Limited since 2018, May 2018 for £10,000. He's taken over by Big Top Limited in September 23. In return for his Claritas shares, Joe receives 500 shares in Big Topco Limited and loan notes of up to £50,000. This naturally would fall within those share for share rules because Big Top Limited has acquired more than 25% of the nominal value of Claritas Limited. Gone for clearance. We've got HMRC clearance to say, yeah, it's all genuine commercial transaction. So we fall within the share for share rules. So the default position is that Joe doesn't pay any tax in the year of disposal. And what happens for Joe is that his shares and loan notes take on the original base cost, i.e. stand in the shoes of the original old Claritas shares. The base cost is a portion between his loan notes and shares. Yeah, and the acquisition as well. So his base cost acquisition date would also be 2018. And those would then come back into charge as the loan notes are paid or when the shares are sold in the future. However, there is one bit of planning here, and this is when there's the last point here about business asset disposal relief election. Whilst the default position here is that you don't pay tax, you just defer the tax into future disposal of shares or when the loan notes are received. There is an election that you can make to stop that from happening, and it's called, I think they call it the section 169Q election, and that's in the tax legislation. So if where you qualify for business asset disposal relief, you can elect for the rollover provisions not to apply. So what that means in this situation, if Joe made that election, the value of the shares received in Big Topco Limited and the loan notes would come to charge in a tax year of disposal. And you think, why would you do that? Because you've got no cash to pay the tax. Well, in this situation, we haven't got no cash for Joe, but you might have had cash in the transaction as well to fund the tax. But if you're nervous, and we tend to see if you're nervous about the tax rates changing, you're nervous around the economy, you're nervous around there's going to be an election which can have a dramatic impact on tax generally, that you might just make the call and you'd rather have the safety of paying the tax up front. You're locked in your tax rate, 10% to 20% if you qualify for business asset. Well, you have to qualify for business asset disposal relief. So you pay your first £1 million at 10%. After that, after gains after that, it's 20%. So it's that kind of comfort that you've locked in and hedged your bets, really. So that's something just to think about and have a conversation with clients who are in this situation. So that's complicated. Probably one of the most, I suppose, complex, but certainly most controversial parts of transaction is what they call transaction insecurities. And this is where we also go for clearance HMRC. And basically, these are aimed at schemes which look to turn income into capital receipts, benefited from the lower CGT rates. These rules are generally applied to most owner-managing businesses. So it applies to a lot of private businesses. So broadly, it's where a seller receives what we call relevant consideration, which is defined there in connection with the distribution of company assets. So basically, in simple terms, in other words, it's where the seller received consideration on the sale, which would otherwise could be paid out as a dividend. So the key thing here is where you've used company assets and you use the sale of securities, shares, etc., in the business to convert what could be an income into a capital receipt. Because obviously dividend rates are up to 40%, capital receipts is 10 or 20%. So there's a massive, there's a massive incentive to do this. And the best way I can put this into context is, well, I'll go to the next slide and I'll come back to this one in a second, just to give an extreme example of what I mean by this, or what the rules mean by this. So an extreme example is here, you've got a shareholder who's 100% holder in Tradeco, and they've got £1 million of cash on the balance sheet, and they've got £2 million of reserves. That's quite important to remember. So in this situation, the easy way for the shareholder to get that £1 million out of the business is to pay himself a dividend of £1 million. That will be subject to top rate of dividend rate tax. I think it's 39.35%. Call it 40% for these purposes. It's obviously very expensive. So you might have had this brainwave. So, okay, what I'll do, shareholder will then, instead of doing that, I'll set up Newco as a sole shareholder. I will then sell Tradeco to Newco for £1 million, which is the value of Tradeco. So Newco now, because Newco has bought an asset from me, from the shareholder, sorry, that Newco now owes £1 million of cash to the shareholder, which you can pay out through Tradeco and Newco. Because this is a transaction securities, it's a sale of an asset. Technically speaking, it's a capital receipt. So what you can see there, shareholder in his mind has converted what could be an income receipt into a capital receipt. So you can see where the weeds is here and what HMRC are trying to stop. And the key thing here is that HMRC look to distribute reserves. How many reserves you've got in the group to make this transaction happen. If there was no reserves in the group, then technically speaking, revenue wouldn't have a recourse to apply the transaction securities rules. But generally speaking, There's always reserves around. We don't tend to see, when you're selling a business, there's always going to be a profitable business with reserves around. So it's very rare you don't see a company with reserves. So yeah, so and there is a main purpose statement. And if there's one of the main purposes of the transaction, one of the main purposes of the transaction is to obtain an income tax advantage, and you actually do have that income tax advantage, then these rules will bite. And what happens is that HMRC will issue it's a self-assessment matter, so you can still report the gain on your self-assessment tax return, individual self-assessment tax return, and HMRC have to counteract it, so they would have to open an inquiry to say that actually these TIS rules apply. That consideration that you've put as capital receipts subject to capital gains tax, that's wrong. We think it should be subject to dividend rate tax, and then we're going to counteract that, and we think this is the right amount of tax to pay. So that's what that can happen on transaction security. So for these purposes, rules are complex, but for all owner managed businesses, I would say 99% of the time, they would fall into the transaction securities rules. There's a clearance process which goes with the rollover provisions clearance as well. So usually you're trying to get rollover cleared. We're also trying to get this cleared to HMRC to show that this is a genuine transaction, and we get HMRC to confirm they won't issue a counteraction notice for the transaction that we're going to do. So you've got to have a strong commercial purpose to do these type of transactions, and 99% of the times you'll know if it's going to be caught or not. There is a gateway test, and that's basically is if collectively the vendors own less than 25% of the acquiring vehicle, then it's called what they call a fundamental disposal, so you fall outside these TIS rules. So you might then think, why do I need a clearance if I fall within those rules? We would always recommend clearance, just because at the end of the day, when you've got a big amount or large amount of consideration going into the seller's personal tax returns, that's submitted to HMRC. That will get flagged at HMRC as a risk, because you're thinking, where's this money come from? It's not happened before. At the end of the day, the shareholders want to sleep at night. So it's more than likely the HMRC will open an inquiry and ask questions about, where we get some money from. Have you really qualified for business asset disposal relief? Is it actually genuine capital receipt? But if you've got that letter from HMRC that has cleared, it says, it does fall within the rollover provisions. It doesn't fall within the TIS rules. There's a genuine commercial transaction that HMRC agree with, then that letter is a powerful tool basically to get HMRC to go back into boxes, because we've seen it before. As soon as you produce a letter, generally speaking, I'll say 9 times out of 10, they go away. So it is a very powerful letter to have. So the common scenario, before I move on, that we see the TIS rules apply, and we see this a lot, is what HMRC don't like is where vendors are not given up control. So whereby, if they've gone from 100 to 70%, they've still got some cash out. The HMRC don't look like that. So, well, you still got control. You've actually, this before and after position is more or less the same whilst you've gone down. But what you use is the company assets to engineer a transaction where you've converted what could have been taken as a dividend in the form of a capital receipt from the sale, like we said in the extreme example. The other example we see is rollover for a similar larger stake and also taking cash out. It's again, it's a similar process. Thinking from HMRC, they don't like that because again, thinking what's changed, but you still got cash out, so they don't like that. But there has been a lot of recent case law where HMRC have lost. For example, there was a case called the Wilkinson case where there was a large amount of, I think it's £100 million transaction, and there was a bit of planning around. I think it's £10 million of planning, tax on planning. Planning on tax, where there was a bit of planning as daughters in the business around getting entrepreneurs relief, but the tax was so insignificant, I suppose, on overall transaction, and there was paperwork to suggest that the transaction would have happened anyway, notwithstanding this bit of planning. So HMRC fought that, but they lost because they said whilst there was a purpose, it wasn't one of the main purposes of the transaction, because in the context of the whole transaction, the main purpose was to get the deal done, and they would have paid a tax anyway if the planning hadn't come off. There was another case recently called the Alum case. As a football owner, I think it's Hull City. I think it was. Hull City, as owner of a football club, where the shareholder was looking to retire, very old shareholder. So he sold one of his businesses to a related business and got the cash out from the business. HMRC fought it and said, actually, like the example I've just given, you just sold to yourself. But HMRC lost. HMRC lost, said actually the personal reasons is not a tax avoidance reason. the reasons for doing that was to fund his retirement. So I think that one was a very unique one on its fact, but I'd be a bit suspicious and skeptical about going for something like that. But at the end of the day, there was a personal reason was accepted as a non-tax reason for doing a transaction. So that's something to bear in mind. And we're also seeing PE-backed transactions recently. We've seen 2 or 3 clearances where I've got one at the moment where the shareholders have not lost control. They're taking cash out. I think it's about 60% or 55% they're holding this cash out. They've got low notes. So my concern was, have they given up control because HMRC don't like that? Have they engineered a transaction to get, an income receipt in the form of a capital receipt? There's a few questions on those clearances that my colleagues have done, and after a few questions, HMRC cleared it because certainly with private equity type of businesses, the ones I'm certainly doing, I've got 8 bidders who've bidded for my client's business. At the end of the day, that's a competitive arms length process. So it's not like the tax was at the forefront of the mind. It's certainly part of the decision making, because that's natural. It's part of all commercial decision making. But the key thing is that's a genuine commercial transaction. And it's a competitive process where that is what how the PE deal with businesses, and HMRC accepted it. So we are seeing movements in HMRC. I think the feedback is that it's a new team, it's a relatively new team, inexperienced team in Birmingham. They're still learning. And it seems like we've had 2-3 steps backwards, but we are starting to move forward. And certainly the courts are favouring the taxpayer more than HMRC. So it's something to think about, and certainly take advice, because it's a very subjective matter that's based on the circumstances of the deal. So before I go on to just bring in, so I'm going to go do a quick case study, and I'll give you a minute or so just to have a look at this case study. But before I go into the cases, are there any questions, Tony, that anyone's had?
Yeah, there's a few that's actually come up, Seth.
Okay.
So it says here, I think this was about 4 slides ago, what is classed as a commercial purpose?
So commercial could be anything, like we just said, could be commercial purpose could be a personal reason. That's why it's not commercial. It's another reason, which is not tax avoidance. The commercial purpose I've got on my current transaction is that the business owners, very young business owners, want capital, want the support of private equity. They're happy to give up some value, but they want the support of private equity to buy and build their business, to go and buy and build their business with other acquisitions, go develop products, that kind of thing. But they need the support of a big backer or someone with money, essentially, that can support them through the process. That's a commercial purpose. Kind of prime example, selling because you want retiring, for example, retiring, and you want to get a new management team, you want to step back. It's personal, but the commercial purpose is you're ready to, you step down, you don't want to be a hindrance to the business, you back the management team, you back the new PE team to support the management team, because they've got ideas to take the business forward, commercial ideas to take it to the next level. So that again is a commercial purpose. So you'll know it's a commercial purpose because, quite frankly, if it's tax driven, you'll know from the conversations. Tax is always a factor, of course it is. That's just because tax is a reason shouldn't naturally, the natural inference shouldn't be that it's a tax avoidance reason, because tax is always a part of consideration in any commercial transaction. But you'll know from the conversation you have with the client whether it's a tax driven one or actually there's other stronger commercial reasons for doing it.
Thanks. There's 2 more.
Yep.
If selling company cannot wait 2 years to implement an EMI scheme for an employee or key person they want to thank or retain post-deal, what are the next best options? So is it an exit bonus paid by the company, therefore has to be agreed with the buyer as low as cash, or paid by the seller shareholders from their proceeds, that kind of thing?
Yeah, so the next best thing to do is look for something like what they call growth share. So what you would try, so because you can't, get within the EMI 2-year qualifying period, so you can issue with shares essentially, because you still got time before a transaction, so you can still get significant minority discounts. So, and what you would do is what we call growth shares. So what you do is value the business on day one. This is one thing of many ideas, but this is the one that works all the time. Is you value the business, and we do it as a tax valuation, not a commercial valuation. So you value the business for tax purposes. You get a value. You know what the value of that business is. That value belongs to the original current shareholders. So they would have that day one value. Anything above day one value at small premium above that, then anyone above above the value at the time we do the tax valuation, then the the new shareholder or the new party you want to incentivize also participate. So I'll probably not explain that very well, but so the current value is for the existing shareholders. Any value from now going forward is shared between the current shareholders and the new people that you want to incentivize. What that means is there's a few valuation mechanisms we need to get around, because it's valuation mechanisms. There's 2 or 3 that are being used at the moment because the market seems to be changing in terms of how they value growth shares. But what that means is that and the time you issue shares to that individual, again, those shares you can get significant minority discounts. You might even get the shares at nominal value for that person. There might be a small amount to pay, but it's certainly not the actual valuation of the business at the time, because you got significant minority discounts you can apply to those shares, just like they get the shares immediately, not an exit. But you can have vesting rights in the shares, and the articles that say that, or in the agreements that say that those shares only vest and exit. That means that they don't have any legal rights until an exit. So if they leave, then those shares, they have no rights essentially. So you can protect the business in that way. So that's one thing we see all the time. And I would say exit bonuses are not tax efficient. So that'll literally be the last thing on the list that you'd use.
Lovely. And final one, it's linked to the income or capital,
Mhm.
where there is a significant level of surplus cash
Yeah.
forming part of consideration. Are there any tax pitfalls for the sellers to consider?
Yes, very good question. So the easiest one to deal with is actually, because a couple of points, it goes far further than M&A. So I mean, so for business asset disposal relief and for inheritance tax purposes for business property relief, the key thing is that you can have shares in a trading business. If you have surplus cash, and that's very subjective because it's in context of the whole of what the business does, then it could potentially turn that business into an investment business. So it's no longer a trading business, which means that you lose your eligibility for business asset disposal relief. You can lose your eligibility for business property relief for IHT purposes. And HMRC also don't like excess cash on a balance sheet where you're trying to get that off the balance sheet by using a transaction to basically get those profits out, or sorry, the income, the cash out via a transaction. So you fall into transaction securities rules. So you would, if you see a lot of cash on a balance sheet in the context of the value, you would certainly ask the question, why is that cash? How is the cash built up? Sometimes you say, well, the cash is built up because it's from trading profits. I want to use it to buy and build. So I don't want to pay out. I want to use it to buy and build, acquire businesses, acquire trading assets, etc. It might have just built up over time. And there has been case law on this as well. HMRC have a general rule of thumb, 20/80 test, where if 20% of the time spent is or 20% of the assets are used for investment purposes, then from their point of view, there's a risk that becomes an investment vehicle. That was tested in the recent case law, and that was thrown out by the judges, saying it's just an arbitrary rule that HMRC use, so you can't really rely on it. So it's all very subjective. It's all very subjective on the context of the company, the business. Do you actively manage that cash? Do you invest it? Or is it just passive, just sits there? Are there any of the reasons why the cash is there, which you can then, are there substantial creditors on the balance sheet? So you want the cash there in case they want their cash, for example, to pay the debts down. So there's a number of reasons why you can start chipping away at why you've got excess cash on the balance sheet. But the key thing is it's certainly worthwhile asking the question, because there are pitfalls there. I hope that helps.
Thanks, that's all.
So I'm just going to quickly cover, I'm conscious of time, quickly cover EOTs. There are a few more slides. I'm talking about the planning side of things using family investment companies and the pre-sale gift of trust. I'm not going to go through those because I haven't got time, but they'll be there for your purposes. So please let us know if you've got any questions outside of this webinar. So EOTs, you've probably heard them. They've been used a lot. So they've been around since 2014. There's all a part of George Osborne's plan about employee ownership. The key thing is here, just quickly going through this, and apologies for talking quickly, is that as long as a controlling interest, more than 50% is sold to an EOT, the whole capital gain is exempt from CGT. So there's a massive incentive for sellers to sell to an EOT. But it all depends on your view, because here you get an initial amount of cash on day one. And usually it's a long-term view because you don't want to put a lot of pressure on target the business. There's a long period of where they can defer the cash, your deferred consideration is paid out over a longer period of time. Certainly ones that I've seen have done are 5 to 7 years. So you have the vendors have an amount on day one, then they'll have an amount that's paid over a number of years, and that's obviously all dependent on the profits generated by target. And but there's also a conflict here. There's always a conflict because the vendors want the money as soon as possible, but for trustees, because you have a board of trustees which is operated to manage the interests of the employees, and then you have the vendors on that board of trustees as well. Trustees' duties are to employees to make sure everything's done for the employees' interests, whereas the vendors obviously have a competing conflict because they only pay it out as soon as possible. So so there are competing interests there which you have to manage. And as I say, if you think it is a short-term plan to sell the business in 2 years, I would say it's not for you, not for that shareholder. If you think I want to give back to employees, that sense of ownership, that kind of John Lewis model, that sense of ownership, I want to reward the employees because they can get up to £3,600 of income tax-free bonuses. They may be able to, on a subsequent sale in maybe 6 or 7 years' time, they may be able to benefit from any growth in value of that business. Then, if it's a long-term play, then that's something that this is suitable for that kind of seller. But if it's a stepping stone to sell in 2, 3 years' time, I don't think it's that kind of transaction, and therefore you back to use your PE and MBOs. HMRC are looking at these; they are inquiring into these because naturally tax drives behaviour. And as soon as the lifetime limit of Entrepreneurs Relief went from 10 to million, this became very, very popular, as you can imagine. So there are a lot of people out there who are peddling these as schemes, and we've seen quite a few, which is disappointing. So HMRC have undertaken a consultation, which we were part of whether these rules are fit for purpose. We don't think they are, so I wouldn't be surprised if there's an amendment to the rules. I always thought they would scrap this, given it's tax-free, but let's see, because it seems to be still in play. But for the right people and for the right sellers and the right attitude, it's a very good scheme to take advantage of. So I'll leave it there. I won't go any further. I'll say these 2 slides, have a look at those at your leisure, and please do get in touch if you've got any comments on this bit of planning. So that's me. The next webinar is Manesho. Thank you all for listening. I'm sorry if I've gone over time, but I hope that was useful. Any questions whatsoever, please do get in contact with Talia or me. Happy to have a one-to-one or, phone call or, meeting. That's not a problem at all. But I hope that was useful. Thank you.
Thanks, Seth.